This graph plots the steep trajectory of inflation throughout the 1970s, and right now, our current macro data is tracking it almost perfectly. Economists are warning that we could be headed for a spike toward 10%. To see what that trajectory looks like on the ground, look at this: a $3 limit per customer at the gas pump. When the dollar loses its purchasing power this quickly, everyday commerce begins to break down. Large-scale investors are responding by rotating capital out of cash and into physical silver to leverage the widening gap between current prices and dwindling global supply. This strategy is built on a physical reality. The silver market has faced a structural deficit for 6 straight years. Industrial applications and investment demand are pulling huge amounts of metal out of the market. At the same time, mining supply is entirely inelastic. Because silver is mostly extracted as a byproduct of mining other metals, producers cannot simply speed up operations to catch up. Think of the silver market as a mechanical system. Right now, it is a heavy metal spring being slowly compressed inside a glass tube. The physical pressure building up inside is immense. With a historic supply squeeze tightening the physical market and inflation quietly eating away at your bank account, holding cash is a strategy for losing wealth. On top of that, international governments are rewriting the rules of global trade, shrinking the available supply of silver even further. The United States, the European Union, and Mexico recently announced an action plan to establish border-adjusted price floors for critical minerals, a category that now officially includes silver. This policy opens the door to large-scale government stockpiling. In the 1960s, the U.S. government maintained a strategic reserve of 165 million ounces of silver to ensure industrial competitiveness. If the U.S. rebuilt that stockpile today, it would consume all of the registered silver currently sitting on the COMEX twice over. Returning to our spring, this government intervention acts as an immovable weight pressing straight down onto the market. By pulling critical minerals out of public circulation, trade policy permanently reduces the available supply, tightening the existing structural deficit. Meanwhile, a completely different kind of pressure is hitting institutional trading floors. The CME Group, which operates the COMEX Futures Exchange, just slashed margin requirements on silver futures by a massive 21.4%. This diagram shows exactly how that impacts the market. By lowering margin requirements, traders can control massive blocks of silver using a fraction of the upfront capital. It gives them extreme financial leverage over the physical asset. This financial leverage acts like pouring speculative gasoline on a fire. It encourages a flood of new participation and liquidity to pour into a market that is already physically constrained. Between gold and silver, which one are you betting on for the next 5 years? Tell me your exact reason in the comments below. These institutional margin cuts act as a second heavyweight compressing our spring, multiplying demand against a limited supply. So we have our spring, squeezed to its limit by structural deficits, government hoarding, and leveraged financial trading. Data from the Scottsdale Mint suggests the market has moved beyond a temporary cycle of tightness. This is a permanent structural reordering of how silver is traded and valued. Inventories are shrinking year after year, and because silver is largely a byproduct of other mining, supply cannot scale to match the demand. This diagram illustrates the problem. Inelastic supply is colliding with rising investment demand at a single restrictive choke point. Because physical supply cannot grow and demand isn't cooling, the only mechanism to balance the market is an explosive move toward higher prices. The choice is between holding a currency losing value to inflation or holding a physical asset entering a period of permanent scarcity. Physical silver and gold are acting as financial lifeboats for the average person to protect their purchasing power. Mining more silver cannot resolve this imbalance. As the pressure on the market reaches its limit, the current price floor becomes unsustainable. Make sure you hold the asset when it finally gives way to the upside.